Yes, very welcome to the next video on Managerial Economics Unit 4 regarding profit. Yes, my dear friend, in this video, we are going to see about what is profit planning and forecasting. It's a very important topic. Listen carefully the video. Then what is profit planning? Straight away, I'm going to the nutshell of the topic. Profit, you know very well. Okay, simple way. And for planning, also, you know very well what is plan. So here comes what is profit planning. So before that, uh, if you want to know whether the business is running in a healthier way, how we can say yes, business is running in a good way, in a good shape. The one point, if the market share of the product is good, means yes, company is going good, like that you can say. And the other thing, and the company is introducing more products and people are satisfied with the product, means yes, company is moving in a good shape. So like that, in order to know what about the company's current situation, the one another thing is, and then the important thing is the profit. See, simply, the company is doing in a profit, means you can say, yes, the company is good. In a simple way. So, if you want to judge the performance of the company, you can just go and see the balance sheet of the company. If the balance sheet shows that it is having a profit, yes, you can blindly say the company is on a right path. So, profit is an important element to say, to come for the judgment that whether the company is running good or not. Okay, so here it comes. And also, earlier video also we discussed business is always with some uncertainty and risk. So you know very well what is uncertainty and what is risk and all. So business always runs and moves with some uncertainty and risk. We don't know what will happen to our product in the coming period, what will happen to our market shares in the coming period. In the same way, we don't know what will be our profit in the future. Of course, we know the exact profit what has been past, but in future we don't know what is going to our profit. Again, the profit is important, not only it's for a running process, it is very important for the survival. So when you can say, if you are asked a question with what is the objective of profits, you can say blindly say it is to for the survival of the business. Business has to go. Business has to be there in future, in 1 year after, 2 year after. But what it is required, only one thing can save the business. That is profit. If you have a excess cash only, you can able to go for a spendings, expenditures, like that goes on. So the profit is an important thing, as you know very well, and profit is important for the survival. Okay, right. And now the firm or a company, institution, you can have in any pets. Firm should be always ready to prepare the to face the uncertainties. Earlier I discussed that business is always with uncertainties and risk, but the firm has to prepare to face the uncertainties in any time. Uncertainties will come in any time, because the word itself it is freely explained that we cannot expect, or we cannot what is it, this will happen in this period, this will happen in this period. No, no, we cannot able to predict that. Okay, so we should be always prepared to face the uncertainties. Otherwise, the survival will be a question mark. We cannot be able to continue the business. We cannot be in the business in the futures. Okay, so we are to ready to face the uncertainty. So how we can face the uncertainties? Because 3 years before, 2.5 years before, we don't know, we don't ever come across the word complete lockdown. Okay, but suddenly it happened. So before the lockdown came, so few people 3 4 months before they started the business. Now they are asked to shut down it. What will happen? What happened to their revenue? They have to pay the interest. Everything will be in a black door. So uncertainties. So we should be always prepared to face the uncertainties. So how we can face some uncertainties is by way of, there are so many ways. And one way is we have to make a proper planning about our profits. Not only in the normal condition, we have to make a proper planning about our profit in an uncertain period also. So in this video, again I'm repeating, we are going to see about what is profit planning and what is profit forecasting. Okay, so here for better profit plan, so I insist you to make a proper profit plan. You plan for the profit. So if you want to make a better profit plan, you need to know about the cost of the product which you are producing or which you are in a trading, and price of the product is another important and essential features for a profit planning. So now you are sitting and discussing and making some workout. You are working out what should be your profit. See, I already explained. Then the profit is not for making to expand your business. It is to survive. First one, it has to be survive. And the first aim is you have to make out the expenses. You have to take out all those expenses at least. So that may be your first profit plan. You have to cover the cost, and you should know, be able to know when we can cover the cost. Even 2 months or 3 months of a financial year, or even in 6 months of the financial year, or by selling this much of unit. So when we are going to cover the cost? So you need a plan. For the better plan of profit, you need three important things. One is cost of the product which you are selling, and price of the product. See, cost is different from price. Cost here refers to the amount which you incur in producing the goods and selling the goods. The price is the revenue. The price is talking about on the revenue side. And another and important point is volume of the product, how much units you are selling. That is very very important. So for a better plan, better profit plan, you need to know the cost of the product, price of the product, and the volume of the product. See, above these three is having some relationships that can be mentioned in a cost volume profit relationships in a simple way. Cost volume profit relationship. So cost volume profit relationship is studied to have a better profit plan. So how to really study this cost volume profit relationship? There is another one technique, important technique. You would have studied in UG, mostly in cost accounting, I think so. Cost accounting, you would have studied this word. Even if you have come across the management accounting, you definitely have studied this word. That is break even analysis. Another point, BEP, break even point. So break even analysis or break even point, you can call it in any sentence as you wish. Okay, so for a better plan, three things is important. One is cost of the product, price of the product, and the volume of the product. These three is having some relationship. By studying the relationship, we are coming one point. That point is called as break even point. So here comes what is break even point, BEP. So BEP is a study. In this study, we are studying the revenues and the cost of a firm in relation with volume of sales. So you are studying the sales volume, you are studying the revenue the company is getting, and you are studying the cost of goods sold, the cost of the firm. Okay. Sorry. And it is the level of sales at which total revenue is equal to total cost. So if you are spending, for example, if you are spending 1 lakh rupees and your sales is 1 lakh rupees, so here is the break even point. The point where you don't have any profit, and the point you don't have any loss. So your income is equal to zero. So expending 10,000 rupees. I am producing some goods and you are selling the goods for 10,000 rupees. So now the cost is 10,000, selling is 10,000. So your profit is 0. Or cost is equal to revenue. On another aspect, the cost is equal to revenue. Okay, the cost minus revenue is equal to 0. So that point is called as no profit, no loss point. No profit, no loss point. So how to determine that point? In which point you can arrive that situation, break even point? In which point? Which point of sale? Suppose you are producing 10, 25, for example, you are producing 100 units. Expenditure is there. Selling cost price is there. So on selling how many goods, you will attain the break even point, that cost is equal to revenue. So that is the way how to determine the break even point. We can determine the break even point in two terms, by in two formats, by assessing the physical units and assessing the sales value. So here it comes, you can arrive the break even point by touching two things. One is physical units and another one is sales volume. So let me explain you, and after the explanation I am confident that you will be able to understand what is break even point by the way of physical units. So sorry, see, break even point is, we can arrive the break even point by using one formula, very simple. So break even point, that formula is fixed cost divided by contribution margin per unit. You have to mark up no other way. So break even point by using physical units, by assessing with the physical units, the formula is fixed cost divided by contribution margin per unit. So fixed cost, you know very well. What is fixed cost? Even whether you are producing or not producing, you are working or not working, your company is running or not running, you have to pay certain cost. That cost is called as fixed cost. That cost is called as fixed cost. Okay. The next item in the formula is contribution margin per unit. So contribution margin. What is contribution margin? Very simple. Contribution margin is a difference between selling price and variable cost per unit. Selling price means, for example, if this is the note, you are selling it for 25 rupees means, so selling price is 25 rupees. So minus variable cost per unit. See, while producing this note, it will incur various types of cost. We have discussed in the earlier unit, I think 2 or 3. So this note will have both fixed cost and variable cost. So here we have to take the variable cost. So contribution margin is a difference between selling price and variable cost per unit. So here comes. For example, you take, it is in the slide. For example, you take a fixed cost is rupees 10,000 per year. Whether you are producing this note or not, you are producing more number of notes or not, whether you are producing less number of notes or not, it is immaterial. You are incurring a fixed cost of rupees 10,000 per year. It is one situation. Whereas in the variable cost, if you want to produce the one note, you have to spend 2 rupees. If you want to produce 5 notes, you have to produce 10 rupees. So 10 divided by 2, sorry, 10 divided by 5 comes to 2 rupees. So variable cost is rupees 2 per unit, and you are selling this note for rupees 4. So you have fixed cost, you have variable cost 2 rupees, and you have selling price 4 per unit. So simply you are applying those data in the formula. So break even point is equal to fixed cost divided by contribution margin per unit. Here the fixed cost is 10,000 rupees. Contribution means selling minus variable cost. So 4 minus 2. So it comes 5,000 unit. It comes to 5,000 unit. So if you are selling 5,000 units, it means that your profit is 0, or your profit is equal to 0, or you don't have any profit or loss. That is the point. So if you are, this is the case, means you have to sell at least 5,000 unit in this year to recover the cost. If you are selling the additional 1 unit, 5,001 unit, then only you are getting the profit. So here comes, what is profit planning? The profit here planned is we have to produce and sell at least 5,000 units in this year to cover the cost. So whether we are getting a profit, how much of profit is the secondary. So first you have to cover the cost. So in order to cover the cost, you have to produce 5,000 units. That is the break even point. So this way you have to planning. Okay, we'll go with the sales value. We have few taken means that time the break even point is equal to fixed cost divided by contribution margin ratio. Here the formula is slightly modified. In case if the sales value is given, means sales price is, instead of sales price, if the sales value is given, means the break even point is equal to fixed cost divided by contribution margin ratio. Fixed cost divided by contribution margin ratio. So what is contribution margin ratio? Very simple. Contribution margin ratio is equal to sales minus variable cost divided by fixed cost. Sales minus variable cost divided by fixed cost. So in this example, we have given sales is rupees 10,000, variable cost 6,000, fixed cost 3,000, and how to calculate the break even point. Okay, here the formula is given. Break even point is equal to fixed cost divided by contribution margin ratio. So break even point is equal to, what is the fixed cost? 3,000 divided by 0.4. How that 0.4 is come? It's a contribution of margin ratio. Sales minus variable cost divided by fixed cost. If you apply, means the answer we will be getting is 0.4. So you are keeping that 0.4 in that area. Okay, so the answer which you are getting is rupees 7,500, which means you have to plan to sell the product at least for rupees 7,500 in order to meet the cost, in order to attain the position that there is no profit and there is no loss. So the profit one starts from 1 to 3. It will starts from minus 10, minus 5, minus 3, minus 2, then it has to come 0, then only you can able to see the profit in a positive integer. So in order to make a profit plan, the two ways there. The first thing is break even point analysis. In that, by having a physical unit analysis, and another thing is sales value analysis. So in this video we have seen just what is break even point and how to derive break even points using some formulas. Okay, so after for your self learning, so break even analysis is one thing, and there is another thing, important concept is called as break even chart. When you are keeping all those sales value, variable cost, all those data in a graphs and examine and establishing in some with relationship, means that is called as break even chart. And for your self study, I am keeping a topic is limitations of break even analysis. See, also this break even analysis having certain limitations. So what are the limitations of break even analysis? I am keeping to your self study. What is break even analysis? So finally in this video we have covered one small topic, what is profit planning, what is our essential for profit planning. And to have a profit plan, there is one concept called a break-even point, and we have discussed the two important formulas into producing how is what is a break-even point, like that. That's it for this video. We will see in the next video what is about forecasting. So it is profit planning, and you have to forecast what will be your profit in the 6 months later, what will be profit in 3 years later, like that. That is called as a profit forecasting. That will be discussed in the next video. Thank you very much. See, bye.